managerial accounting, planning and control, variance analysis. Now, what we have in front of us here is a summary of all those variances that we just calculated together. Now, a couple of things to note about these variances. First of all, the materials price quantity, labor rate efficiency, variable manufacturing overhead spending and efficiency variance. All of these variable product cost variances will add up to equal the net variable cost of goods sold flexible budget spending variance that we calculated on the Flex Budget Performance Report. So what we have done in doing these calculating these variances is taken this amount and drilled down to get more detail to identify possible causes, who's responsible, and in turn who can take action to prevent the unfavorable variances from happening again in the future, or to reinforce the activities that led to favorable variances. You'll also notice I've got listed here the fixed manufacturing overhead spending variance, because this entered into the variance for net operating income as part of the total cost variance. Not only this is part of the product cost variance, but we've also got the selling and administrative expense variances that affected net operating income as well. Now, which of these variances should be investigated? For which of these do we ask those questions and drill down until we find out what happened? Do we investigate all of them? Do we only investigate unfavorable variances? Or should we investigate favorable variances also? Well, it depends on the company policy as to which variances are big enough to make a difference in the future success, the future performance of the company. Now, you'll also notice that down here I've listed the flexible budget variable cost of goods sold, the amount of cost of goods sold that we should have incurred for 23,000 units produced. One way of deciding which of these variances should be investigated is simply to look at the size of the variance related to the flex budget amount. So, for example, what if we decided that any variance that is more than 2% of the flex budget variable cost of goods sold should be investigated? Well, let's see, 2% of 414,000 is going to be $8,200 and something, $8,280. So as we look at these variances, if that's our criterion, then this $18,400 favorable materials price variance would be investigated, because it's certainly larger than $8,000. So would the quantity variance, but we would not investigate the direct labor rate variance because it's less than that $8,000. We certainly would investigate the labor efficiency variance, but we wouldn't worry about the variable overhead spending variance. And we would also look at the efficiency. And remember, we said that these are calculationally are related to one another. So that's one way that we would decide. We would compare each variance to some percentage of the flex budget amount. Now, a second way that's a little more statistically effective, I guess, is this guy. This is called a statistical control chart. And without going into too much detail about what's behind this, what we've got here, this is a line that represents the cost that should be incurred. And then these dots are the variances relative to that line. Above the line, favorable; below the line, unfavorable variances. The little blue lines up here are +1, -1 standard deviation away from the costs that should be incurred according to the standards. So which ones would we investigate? Well, if the variance is outside ±1 standard deviation from standard cost, then it should be investigated. So these aren't necessarily our variances, but looking at this chart, the ones that we would investigate from this set of data, that one is 1 standard deviation above standard cost, so we'd investigate it. This one is more than 1 standard deviation below, unfavorable variance. So those are the ones that we would investigate. So either way, whether it's size of the variance relative to the flex budget amount, or whether we go through the trouble of preparing a statistical control chart, we compare those variances with what the cost should be, the standards. And if there is a significant enough difference, standard deviation significance, then we will investigate the variance. If there isn't a statistically significant difference, then we will not investigate the variance.